So imagine a scenario where you did everything right. You found the right deal, you negotiated the contract, you're under contract, you maybe even completed the due diligence and you're starting the loan process, and all of a sudden you're getting no's from your lenders. Okay, they're looking for a certain liquidity, net worth requirement, debt coverage ratio, and you're like, what is all this stuff? And you can't close on the deal because you can't get financing. Okay, can we try to avoid that here? All right, so what I want to do in this episode is kind of talk about how you can prepare yourself best for the financing, so that the financing is really a non-event. It's not like, ooh, am I going to get financing? Let's see. Let me worry about this over the next few weeks, and then run the risk of you not closing on a deal. Okay, that's not good. That's just about as bad as going into putting a deal under contract and not having the equity. Okay, or at least some of it or half of it, and raising money before you have that deal under contract. Okay, it's the same thing with financing. This is not a hoping strategy. So what I want to talk about is what you can do beforehand, and to try to understand what some of the lender's underwriting requirements are, and you're familiar with some of the terms. Okay, so bottom line is this: you want to start networking with lenders long before you start putting deals under contract. And my rule of thumb is 5. Okay, ideally brokers. You're welcome to talk to bankers as well. The advantage of brokers is that they have multiple sources. So they have multiple loans, either for stabilized or construction loans. If something doesn't work out with one, they can get another one. They can shop terms and get you the best. So brokers are actually ideal. Now, so what you want to do is you want to get together with these brokers and sit them down for lunch and say, hey, look, here's the kind of asset I'm looking for. Here's a little bit about myself, and what are you looking for? How are you going to underwrite these deals? You have to understand how a lender underwrites the deals so that you underwrite the deals in the same way. All right, so let's start with the first one, which is debt coverage ratio. Debt coverage ratio is basically the income of the property divided by the debt service. Okay, so obviously there's income. Let's say it's $100,000, and hopefully your debt service is less than that, and that ratio has to be at least 1.25. Okay, so that ratio has to be 1.25, which is not too hard to do. It's not a huge hurdle. Okay, so that's really not a showstopper. The other one is loan to value. Okay, so a bank will loan you anywhere from typically 80% or from 75 to 80%. So when you're underwriting, when you're putting this into the syndicated deal analyzer, I always use 75%, a little more conservative. If it's a stable property, you can probably get as high as 80%. Just so you know how to underwrite that deal, because obviously that affects your returns and the amount of cash you need as well. All right, what else we got here? Now, here's a couple of other requirements that the bank looks for, and one is a net worth requirement. So you as a sponsor or the syndicator, the bank or the lender is looking for a net worth of the sponsor or sponsors equal to the loan amount. So that means that if your loan is $1 million, then you better have a net worth of $1 million. Okay, now, don't get all excited here. There's a lot of people who are doing $1 million deals or more and don't have a $1 million net worth, okay? I'm just saying that's how the bank is going to underwrite it, which means that if you don't have the net worth equal to your loan, you're going to have to partner. Now, if you're raising money with this is no problem at all, right? Because you're talking to the investors and you're getting them commitments to invest in the deal, but you're going to ask for more than that. You're going to ask them to be a co-sponsor. Maybe you'll pick one person who's particularly who has a high net worth, that is one of your investors. You want to keep it to a minimum, maybe one, maybe two people, and you ask them to be a co-sponsor for you, okay? So, and that will help satisfy the net worth requirement as well as the liquidity requirement. So banks like to see an equivalent of 6 to 9 months of debt service liquid somewhere. So they want to see this leading up to closing. They want someone's bank statements or brokerage statements or something that has 6 to 9 months or 12 months of interest payments in there. Okay, and then once you close, you don't have to keep an account with them or keep reporting on that. It just kind of goes away, right? So you're basically asking for someone's brokerage statement or bank statement, okay? Almost like a proof of funds, if you will. So if you don't satisfy those two requirements, then partner to get them. So get them from your investors. Now, I wouldn't offer any compensation for your investors. Say, look, I need you to sign on the note. It's whatever. It's going to be a non-recourse note, whatever. And I just need you to sponsor this with me. And would you be willing to do that? And they gotta go, well, okay. Or they might say, well, what's in it for me? And then what you could do is compensate them either with a fee at closing, like an acquisition fee, or some extra percentage equity above and beyond what they would get if they invested their money, 2-3% or something like that. Some kind of compensation, whatever you work out with that investor. So they are now a co-sponsor on that. Okay. Now, personal guarantees. Banks love personal guarantees. Okay. Typically, and this is odd, when the loan balances are all below $1 million, you almost always have to personally guarantee the loan. And if you don't like that, which you shouldn't, it is another argument to go as big as quickly as possible so you're above that $1 million threshold, okay? So, again, these guarantees are negotiable. So what you could do, even if there's a personal guarantee, you can bleed them off, say over a course of 3 years. Each year, a third of that guarantee goes away. So you can negotiate that as well. You can also negotiate by maybe putting more money down in return for no personal guarantee or as a less of a guarantee, okay? So now if the loan balance is higher, the chances of you getting non-recourse is much better. Non-recourse basically means that there is no personal guarantee. The bank simply has, the only thing they can go after is the asset. They can't go after you as a sponsor or any kind of co-sponsors. You still need to sign on the loan, and you only have recourse if there's fraud involved or some criminal act, okay, which most cases hopefully that doesn't apply to you. You never know. And so getting a sponsor for something like that is going to be much easier than something where someone has to personally guarantee a loan. Okay, so you can negotiate that guarantee, putting more money down, bleeding it off, whatever you can, maybe paying a little extra, maybe paying some more points, whatever, okay? But you want to try to not have a personal guarantee. The best way to do it is to have a larger loan balance. All right, so 3 key points to keep in mind from this lesson. One is partner. Okay, don't let the fact that you only have a small net worth or liquidity stop you from big deals. Go raise money and get your investors to help you with proof of funds, earnest money deposit, liquid net worth requirements, okay, all that stuff. Number 2, go big as quickly as you can, which talked about. Okay, there's actually just benefits in going bigger, and that's one of them. And the third lesson here is talk to your lenders early. Don't wait until you have it under contract. Same way with your investors. Establish a relationship early on so they know who you are, what you're looking for, your background. It's all personal relationships, okay? So you're going to give them a package. They're going to know who you are, and you're more importantly going to be familiar with how they're going to underwrite different deals. So you're not guessing and stabbing in the dark. Anyway, hope that was useful, and talk to you on the next episode. Hey there, and thanks so much for sticking around to the end of the video. I want to give you 3 things to do in sequence. Let me give you a quick tour of what those 3 things are, and then I'll show you how to do them. Number 1 is to download my free ebook called The 10-Minute Offer. It's all about making offers quickly, accurately, to give you confidence about analyzing deals and making offers. So that's the first thing. The second thing is to subscribe to my YouTube channel because I put out new videos all the time, and I want you to make sure you get them. That's number 2. Number 3 is to watch the next video in line. All right, so I'm going to go give you a chance to do that right now. And when you click on one of these things, a new tab will open up, and for the ebook. Okay, so click on the ebook, and new tab will open up. The video will stop playing. You can go back to the video and click on step 2, which is subscribe to the channel. That'll open up a new tab as well. And then 3 is when you click on the last one to watch the next video in line. That'll open up in the current window. All right, I appreciate you guys, and I will catch you in the next video.